morning, good afternoon, good evening. Welcome to part 2 of Module 2, Chapter 7. In this module, we're going to pick up where we left off on the last module where we learned to capitalize or to an expense. So let's talk about real quick recap. So when we're talking about long-term assets, we're talking about whether those costs are capitalized, which means added to the balance sheet. When they are added or capitalized, and subsequent to that point, they will have to be depreciated over their economic useful lives. So let's go ahead now and talk about, remember it was going to be a SAD topic, so the methods that are under SAD are straight line, activity based, and declining balance, SAD. So let's go ahead and see what we can pick up here from our last cost. So let's talk now about the final phase of long-term assets. The first phase is, what do we record the historical cost at? Remember, all necessary costs to ready the asset for its intended use are capitalized. All unnecessary costs are capitalized. And then after acquisition costs, how do we treat them? And they fell into the buckets of improvements and additions, which are capitalized. And then routine repair for ordinary types of things are expensed. Finally, we get to the phase of how do we allocate the costs once we capitalize them and put them on our balance sheet. How do we allocate those costs to future periods? So let's assume that the cost to purchase an asset in the initial period was $10,000. So we'll say that it's an asset, so it must contain future benefits. So we'll know that that $10,000 is going to be allocated to each period of the 5 periods because that's when the revenue will be generated from that asset. And according to the matching principle, remember, all associated costs of producing revenues have to be expensed in the period in which they are incurred. This just happens to be an allocated expense, as we saw with, similar to what we saw with bad debt expense. It's an estimate and it's allocated to the income statement. Well, the same thing with depreciation. It's an estimate. There are several estimates that go in there. The residual value is an estimate. The economic estimated useful life is an estimate. All of these things are estimates that are prepared by management. So how much cost should we allocate to each period? Well, the allocation, the portion of the cost that we allocate to each year is going to be determined by the depreciation method that the management or the corporation chooses to use. We will study 3 methods, so as you know, those 3 methods are SAD. So equal amounts across years will be known as straight line. It's the easiest method. Where we record greater amounts of depreciation in the earlier years and less in the later years is known as declining balance. And then finally, where we used a proportionate amount based on the benefits received in a given period, that's known as the activity-based method. Notice the S, the A, and the D. So now let's look at a quick example on straight line depreciation. You'll need to remember what the depreciable cost is, or depreciable base, the depreciation rate, how to calculate the depreciation expense from the very first introductory module on Chapter 7, the terminology. So let's assume that we have the following asset that was purchased. Let's assume that the asset cost $11,000, but we incurred $1,000 for shipping and to install the machine. The $1,000 would be a necessary cost, so we would add it to the original cost to get a total historical cost that we would capitalize of $12,000. We estimated the selling price of the asset in 5 years, which is known as residual value, to be $2,000. We estimated the expected useful life to be 5 years. What is the amount of depreciation expense in each year? So how straight line method works is, first calculate the depreciable base. What is that? Cost minus residual value divided by the number of years. And that will be your fixed monthly or yearly annual expense that you would record. So again, you can look at the red numbers. Your $12,000 is your cost that you capitalized, minus your residual value, divided by or multiplied by 1 over the life in years, which is 5. So multiplied by 1 over 5 is the same as showing it as this amount in the numerator divided by 5, same as multiplying by 1 over 5, correct? So it'll give us 2,000. The beauty of this method is, once you get the depreciable base in the initial year and you get the right expected useful life, it is going to be a fixed amount each year. So you'll notice 2,000, 2,000, 2,000, 2,000, 2,000. So the question is what is the total depreciation over the 5 years? Correct, 10,000. Does the company depreciate the residual value? The answer is no, right? Residual value, go back to what it is, it's the estimated selling price in 5 years. So that will remain undepreciated on the company's balance sheet. So once the company fully depreciates the asset down to residual value, it sits there until such a time the company disposes of the asset. And that's also part of Chapter 7, where you dispose of a fixed asset and you either have a gain or loss on disposal. So this is straight line depreciation. Let's go to double declining balance. This is the harder method, everyone, so please pay attention in this short little example here. Suppose the company purchased the following asset. Again, let's deal with the same fact pattern. $12,000 will be the historical cost, the 11, plus the necessary costs for shipping and installation. We still have the same estimated residual value. The expected life hasn't changed, it's 5 years. Let's calculate the amount of depreciation expense each year. First thing with double declining balance method is that all you need to remember is when it's double declining balance is it's twice the straight line rate or double the straight line rate. So what is the straight line rate? 1 over the life in years, right? 1 over 5. So what would be doubling that? Would be multiplying by 2. So we would say 1 over 5 times 2, so the double declining rate would be 2 over 5 or 40%. 40%. So now, once you know the depreciation rate under double declining, you just double the straight line rate. Another thing you're going to do is you're going to initially ignore the residual value. You don't ignore it entirely. We'll worry about it in the later years. But in the earlier years, what we're going to do is we're going to calculate the depreciation. Okay, it's double the straight line. We're going to go ahead and take the historical cost, the amount that we capitalize. We're going to multiply it by the double declining rate of 40%. So the depreciation is $4,800 in year 1. Now, you need to remember another terminology that I taught you earlier on, and that is what is book value? What is book value or net asset value? Correct. It's cost minus accumulated depreciation. So we always figure out the depreciation by taking the beginning of year book value multiplied by the same double declining rate, the 40%. So in year 1, it was easy because the opening book value, because there was no prior depreciation, was 12 minus 0. So 12,000 times 40% is 4,800. But at the end of year 1, we record 4,800 of depreciation expense, so now the book value goes down by $4,800. So in that case, year 2's depreciation will be 12,000 minus 4,800 times 40%, or 2,880. Notice how this is decreasing, because this is a pattern of what we call accelerated depreciation, where we have more depreciation in the earlier years and less depreciation in the later years. So what would be the depreciation in year 3? Well, it's based on the book value of the depreciation at the beginning of year 3. So again, we have to take the cost and we have to subtract out year 1 and year 2's depreciation multiplied by 40%, and now the depreciation expense is $1,728. So you're seeing the pattern here. Pretty easy, right? Let's do the same thing in year 4, except now we have year 3's depreciation to add in. If we do that, we will get 1,036.80. The problem with this, everyone, is notice the do not equal sign, is that this does not work, because if we use this 1,036.80 here and add it to the prior years, we will have depreciated this asset below the residual value of 2,000. Because remember, the book value is cost minus accumulated, and we stop depreciating once it hits 2,000. Under straight line method, it happens automatically because of the math. But with the double declining balance, you have to be careful in the later years. You're going to have to override the formula and just force the depreciation expense in the last year. So matter of fact, if you add these all together, you'll get exactly $10,000. That's how you know you're fully depreciated. We cannot use what the formula tells us to use. So here we're forcing the depreciation. So now we're fully depreciated at the end of year 4, so that means there'll be no further depreciation in year 5. So what is the total depreciation over the 4 years? If you add these blue numbers up, you'll get 10,000. Correct. Does the company depreciate the residual value of 2,000? No, they do not, just like straight line. So really the only difference between straight line and double declining balance is number one is that the depreciation rate is double the straight line rate. Two, we initially ignore the residual value in estimating the depreciable base, which is cost minus residual value. We just base the depreciation in this method based on the beginning of year book value, where beginning of year book value is cost minus accumulated depreciation. And that's basically how this method works. So hopefully you'll get this method down. Problems could be varied. I could ask you what's the depreciation in year 1, or I could be a little more complex and said what's the depreciation in year 3, or as a real trick question I could say what would the depreciation expense be in year 5 or even in year 4. And if it was year 4, that would be the trickiest way to ask it, because you'd have to then obviously figure out that in that year you're going to over depreciate it, so you have to force the depreciation expense so that you don't depreciate it below residual value, which is $2,000. We must freeze it at $2,000 once the book value hits $2,000, because that's the residual value. So how do we record depreciation expense? We record the initial purchase as an asset, so debit and asset. Assets go up, and we use our cash generally, so a cash asset goes down by equal amount. Then when the asset is used in future years, it costs has now helped to produce revenues. So now we've got to allocate a proportionate share of that cost as an expense. So we would go ahead, remember the acronym DEAD, D-E-A-D, that's your entry for depreciation expense, debit depreciation expense. Expenses go up, stockholders' equity goes down because expenses decrease retained earnings, and retained earnings is part of stockholders' equity. And we credit the contra asset for $2,000. Depreciation expense is an expense in the income statement. Accumulated depreciation is known as a contra negative asset in the balance sheet. And it represents what? The amount of the asset that has been consumed or depreciated over the asset's life. So let's look quickly, using the straight line depreciation of 2,000, let's look at what the balance sheet effects would be and the income statement effects would be. Here's our asset cost. So this is what we would call historical cost, our original cost that went on the balance sheet. Here's our contra asset column accumulated in year 0 at the beginning. It's 0. The net asset value or book value is 12,000 when you take this column minus this column. After year 1 we had 2,000. We're going to use the straight line example of 2,000 per year. So cost minus accumulated is a net asset value of 10,000. In year 2 we book another 2,000 of depreciation, so our accumulated depreciation on the balance sheet now has a $4,000 credit balance, which reduces our net asset book value to 8. See the pattern? Notice another 2,000 in year 3, book value goes down. So as accumulated depreciation increases, the net asset book values decrease by proportionate amounts. 8,000, and then finally the final 2,000 goes into year 5, and we're left with 2,000 as our book value, or also is the residual value. Notice on the income statement, since it's an expense, we just record 2,000 per year. So notice that the asset remains at a historical cost of 12,000. Notice that accumulated depreciation increases each year, and the net asset decreases by proportionate amount. Remember that accumulated depreciation is the depreciation expense over the asset's life. This represents the depreciation over 5 years. That's what's always kept in this account, the accumulated depreciation. The income statement only records each period's expense. And notice that since depreciation expense is a temporary account, it's part of TRED, each year this $2,000 expense is closed out into retained earnings, and we start the game clock all over again in year 2 with a 0 balance. 2,000 goes in. At the end of year 2 we close out this expense and reset the game clock, because that's how temporary accounts work. But on the balance sheet, your asset values and your contra assets never get reset to 0. Because why? They're your pals, right? And good pals stick around for a long time. Well, this concludes our little part 2 of our demonstration video for how to calculate depreciation expense under the straight line method and double declining balance method. I hope you found this helpful. Enjoy the rest of your evening, afternoon, morning, whatever time it is while you're working this. Have a great rest of your time. Take care, everyone. Great work.